What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money investing in fractional real estate online, as usual. Today we are getting, a new listing on Lofty, that one that fits squarely into their anything legal buy box that they described recently. I really don't want to be that mean about it, but it's frustrating to see the same sorts of mistakes happening over and over again. I think that this listing, I'm going to go through all the numbers and everything. I think it's going to put investors at the same sort of risk of what we've seen a lot of. And so I'm going to dig into some numbers of that, and also talk a little bit about, if I did want to invest in this, what I'd really ask for in order to make me comfortable doing so. But first, let's jump into the property itself. It is a 6 bedroom, 5 bathroom, 4,000 square foot single family home in Surfside, Florida. It's brand new construction. It was built to sell, but has been rented. There have been a few people that complained about the way it looked in Discord, but I think it's a perfectly good looking home. It is a high price point. They've got it mentioned at 4.5 million, but there isn't an appraisal yet. To be completely fair, this listing isn't complete. Max actually mentioned that in the Discord today, that some of these are going to be placeholders. I think that everything that I'm going to talk about isn't going to be things that are going to change. I'm going to dig into, I'm going to use the lease rate that from the lease that they uploaded already. I'm looking at the insurance and the taxes, all that stuff. Everything that I'm going to talk about, I don't think will change. I sort of ignore a lot of the numbers they provide anyway, because some of it's just sort of fiction, um, or just, yeah, I don't know. I don't know how else to describe it, but um, it's not as important when evaluating the deal itself, right? But so, uh, gonna jump into the specifics of the property first, and then I'll go into um, the numbers, and then what I think maybe we could do to make it a deal that does actually work for people. So obviously, I think at the moment it probably doesn't. So you can see this was listed for sale for a while, and I think originally, how far back do we go? 4.69, so 4.7. So they bought the land, I think. I think this is the purchase of the land, or maybe there was a house and they tore it down. When you look here, you can see a home. I don't know. I don't know if that had gotten wiped out by a storm or something. I really have no idea. We'll get into the flood zone issue in a few minutes. But so they bought it for this. This is not the home that exists anymore, right? They built a brand new home, listed it for 4.6 initially. Um, Interestingly, that price got listed for higher, and then it's sat for a while. They've changed the price. They've gone up a few times. I don't know what maybe they did some different things to the property. I have no idea, but ended up going down and then listing it for rent at this 27,000. But it's has since just been rented for 22,000 a month is the current rental rate. But so the home itself, I mean, I think new construction, not a lot to complain about. Maybe not to everybody's tastes, but I do think it was built to, you know, uh, for a pretty wide audience, and whoever is going to buy it, it has kind of a blank canvas to go and do what they want with it. Um, I mean, I'd be perfectly happy with that kitchen, right? Like, I always love the giant stoves. But anyway, probably didn't know this about me. I cook a lot. Based on the food pictures that I post, if you follow me on X, you might not realize that I actually like to cook good food, because I also love eating trash food, and those are the fun ones to post. But yeah, okay, so let's close that, because I'm not even going to talk about valuation. I really don't care about the valuation. I think they're going to do an appraisal. It's probably going to get sold at some premium to that appraisal. I don't think it really matters for what I think is really important with this. So, okay, Surfside, Florida. It is a beach town. You're not right on the beach with this property, but you're pretty close. Um, it's had a shrinking population. I kind of wonder if this is due to storm damage and rebuilding, and this is in Dade County, and so they do get a lot of storms. I don't know that that's what's going on. It's also possible that I mean, it's not a huge loss of people, but it is shrinking. But this is in the Miami market, which has been, growing pretty strong. So overall market is decent, but the sub market that this is in, shrinking population for some reason. I don't know what that is. Obviously I don't love that, but it's, because the market itself is growing. I think sometimes when you have these real small submarkets, because you can see it's less than 6,000 people, you could have some major construction projects like take out an apartment building, and all of a sudden, uh, there's that changes your population quite a bit. So, if you were interested, you want to dig into that more, you could probably figure it out. But for me, the bigger market trend is what's more important. Also, you can see this isn't an AE flood zone. For me, that's a no-go. I just don't want to deal with flood insurance. I don't want to deal with rebuilding after a storm. I mean, so in my mind, this is just a no-go for an investment property. I understand people live in this area all the time, and if it's your home and taking that risk and having to deal with it at some point is one thing. If it's an investment and you're not making a ton of money on it and you have to end up dealing with that, uh, you are just not getting paid for the time that it's going to take. Like it is, and trying to deal with this through a DAO structure, I can't even imagine. I think this would be very difficult. The crime map looked really clean nearby, and then I'm guessing there must be like some downtown area or something because it seems like all one little strip. Again, I'm kind of running through this stuff quick because I want to have a decent discussion about the actual numbers and about the problem that we just keep seeing over and over again, and maybe some solutions for addressing it, or what I'd want to see in order for me to want to buy into it. Right? I already showed you this map, so this is the home that was there before. This is one thing that I think is a little bit problematic. I don't ever want to be the nicest home in a neighborhood, and maybe we're not, but it is. This is actually when the construction is going on. But some of the pictures, oh, maybe it's in these pictures. Some of the pictures just made it look like, can we go backwards through there? That it's a huge home relative to a lot of the neighbors. Um, yeah, here we go. Like it's this home, and you have, I mean, I guess maybe there are some other big homes, but you never want to be the most expensive home in a neighborhood. It always gets difficult to sell, even if it's clearly you should be the most expensive because you're bigger, nicer, you got a pool, you got. I mean, it's one of the things that I worry about a little bit. Um, Another thing I wanted to mention with this one before I forget is it was built to sell, right? And it didn't sell, and it didn't sell at the 4.25 million or whatever it is. One thing is when you have this brand new construction and then someone's lived in it for a year and then you go list it for sale again, the people that really want to buy a brand new home, you're not going to get those same people. And so your market, the amount that you're going to get on for it, I mean, it's not like a car where you just have this massive depreciation your first year, but you will have, it's not as easy to sell when it's not a brand new home at those, at the prices that you'd want to get for them. Of course, they can go through, because the co-owner was the builder for this. I'm sure they'd have the ability to go through, with a punch list and fix everything. But I think that it just there's just some people that have this. I've had people tell me before because my day job I sell real estate, and I've had people tell me I just don't want a used house, which is the funniest experience. I grew up in an area where every home is 50 or 100 years old, and so that concept is mind blowing to me. But there are those people out there, so it affects your market a little bit. Um, so I think that size issue and the being a bigger, nicer home than a lot of the neighbors could be a problem, although I think it's also possible that there's more and more of these homes being built. But let's see. This is what I want to really get into, though, is the numbers of this. Okay, so um, we have, and I'm just pulling all of this from the info that they gave us. So let's see. We have a lease. Where'd my lease go? Okay, we have a lease. The way it works up here is maybe a little bit confusing, right? Your first month's rent's 22,000. Last month rent plus applicable taxes is 23,000. $22,000 security deposit. The way that's written doesn't make perfect sense, and then the total amount over the lease term. Um, but if you go into this section here, additional terms, they tell you, okay, it's 22,000 from June 1st until November 30th, and then it's gonna be 23,000. But so I'm doing my math on 22,000 at the moment, and you can see and I don't think I don't think this will change. There's a $3.3 million loan. The co-owner is responsible for making that loan payment. He mentions, there's two extensions up to, so a total of up to 12 additional months. Um, and then, the plan is to refinance as soon as, because rates are going down right now. Rates are going down. They have moved down a little bit recently, but I always am terrified to make any sort of investment decision with the assumption rates are going to go down. I mean, when I'm looking at the mogul deals and they're talking about refinancing at a lower rate within the next 5 years, I always question that, right? And so this is in the next year, are we going to be able to refinance at a lower rate? And maybe is the answer, right? I don't know, but so that's the rationale there. So looked at the loan documents. Oh, and actually, was I using the wrong amount? Yeah, they're paying 27,500 to 27,500. So my numbers are all off because I'm using 27,000. So let me add that 500. I'm going to do that in each of these because I did three different scenarios. Oh, it's not going to matter in the other two. It's just going to matter in that one. And this is just multiplying it by 12. Yes, it is. Okay, good. So, we've got our rent. So I showed you the lease renting at 22,000. Um, they have the management fee available or the management agreement available. They're only managing it for 5%, which is nice, But and I think that we could find someone else to manage it for 5% because it is a very large payment and it's a single family home, right? Rent $22,000 a month. Um, it seems like you could, that's I think we could find that. So, and that's the thing, right? Like when I'm doing all this math, it's because we've seen over and over again now multiple two big situations, but it is I think you're just starting to see those cracks more and more where the co-owners that are doing a deal like this where they've agreed to pay the mortgage in some cases they're just saying I'm just not going to pay the mortgage. In some cases they're saying I can't pay the mortgage. We have a whole bunch of votes right now surrounding properties that are in those situations. And we realize like we don't have a ton of recourse. That co-owner has an obligation. There's a promissory note that they need to pay, but the bank gets to enforce that, right? We don't. Um, and so I'm going to talk a little bit more about that later, but that's why I always want to look at like, well, what do these actual numbers look like? Okay, so we've got our total revenue, 264,000. This isn't exactly right because you're going to get up to 23,000, but I'm just looking at it. Really the month by month is what I care about. I mean, I think even if we change this to 23,000, it's not going to change our situation a whole bunch. But so okay, management fee. That's the 1.1K. Insurance, there was two pieces of insurance that they gave us. They gave us this is their total insurance, and it seems like the flood coverage, which they also gave us, was a separate bill because I didn't see this listed in here anyway, right? Okay. Yeah, so I added both of those in there and then divided by 12 to get our monthly insurance. So you can see $1,400 a month in insurance. It's quite a bit. Um, And then for taxes, I actually relied on. So there was a discussion about the taxes already in the Discord. Um, there's a. It looks like it's going to be assessed at 2.8 million. I don't know, and I'm just relying on those numbers. It could, if it was as assessed at the 4 million, then this gets much worse. And then there's this county website you can put like a calculator in to see what the taxes would be, and so that's where this 53,000 number came from. Um, whether or not that's exactly accurate, I'm not sure, right? If you want to dig into this, you do want to do your own due diligence on that, just like I tell you with all of this stuff. And that is a good reminder. Please like and subscribe. In the description to this video, I have links to all the websites where I'm invested in fractional real estate. Please do your own due diligence on any of those platforms that you see me talk about and on any properties that I talk about as well, right? Just because I buy or don't buy something doesn't mean it's the right answer for you. We have a different, time horizon, risk profile, goals as far as our investing. So you just want to do your own due diligence on all that. Also, in the description of this video, there's a link to the Discord that I have set up that is just a generic fractional real estate investors Discord. We talk about several different platforms. You're welcome to join that. Jump in and talk about this. Talk about any of the stuff. We on any given day. Now we have over 100 members in that Discord, and quite a few people that are there regularly. Smart guys that are talking about. I say guys. There's perfectly possible. There's ladies in there too, and I just don't know. Um, the all the ones that I actually have talked to, like on video calls, have been dudes so far. So maybe we need to think about that. Maybe we're not being very inclusive as a group. And I don't know. I guess people seeing me here on my couch, I'm not a very good looking dude. Maybe they know I'm married. I'm taken. So maybe that's what's happening. I don't know. But anyway, if you're a lady and you're into this stuff, you can also jump into the Discord. There is at least they're not terribly immature in there. So you're welcome to check that out. Okay, that was a really weird aside. Sorry about that. But yeah, so don't take these numbers at face value. If you're going to invest in this, you want to check on that, right? Um, and so then, yeah, we can see the loan payment, and this is an interest-only loan. It's at 10% interest, I believe. Yeah, 10% interest. Um, it's the loan is due, right? Is this the next due date, right? But then, oh no, the maturity date 9/1/2025. But then they can extend it. There's two potential extensions that they mentioned, so up to a year is what it looks like. So what does that look like? Okay, just so now we're just talking about management fee, insurance, taxes, and interest payment. We have no vacancy collection loss built into this. We have no repairs and maintenance. Um, but so just if we had to take over the loan in a perfect month, right, where we're just paying a manager, insurance, taxes, interest only payment, that's $34,000 in expenses, right? So on a monthly basis, we're in the hole $12,482. Uh, that's if we had to pay the mortgage payment, right? Like now you can tell they're doing this as their typical co-owner deal where okay, the co-owner is responsible for making that mortgage payment. But like I said, I mean the risk is at some point they either can't or they won't for whatever reason, and then the Dow is at risk of either losing the property or having to take over those payments. Like I said, I mean you can see if you look at the properties that are many of them that are, Thunder Sun Homes is the co-owner, are changing hands right now because he's indicated that he's not able to continue making the payments on some of them, and so there's nervousness about all of them. All the Yom ones that there's several of those where there's a discussion of, well, I'm just not going to pay that payment anymore. It's the Dow's responsibility now. Uh, in any case, I think it's a real risk, and so any property that comes to the platform that I'm going to invest in, I'm going to do this analysis on. And if it shows that that property has a negative $12,000 a month cash flow, it's really hard for me to get excited about investing in that, right? Like no matter how high, but as soon as somebody else is paying the mortgage, then you can start paying out some kind of rental yield. And again, these are placeholders, right? Who knows, we'll have to see what the appraisal is, what they actually sell it for, what that yield looks like. But remember, that yield only happens because somebody else is paying the mortgage. As soon as the Dow has to pay it, we're losing money every month. Okay, so I did a couple different. We're talking about, well, we're going to be able to refinance, right? Well, rates come down. Well, what if they come down to 6%? Okay, well, we're still losing almost $5,000 a month at 6%. And again, this is without looking at vacancy collection loss, without looking at any kind of repairs and maintenance. Although maybe by then, we're up to the $23,000 rental rate. And okay, we're now just almost $4,000 a month in losses, right? So if we can refinance, but it only gets down to 6%, we're still in trouble. I'm going to change it to 23,000 again here. And if we get down to, I just did a couple different versions, and okay, if we can refinance with a 30-year loan and get to 4%, that's what it's going to take before we're cash flow positive, right? I mean, just right around 4% on a 30-year fixed, that or 30-year amortization is where yeah, of course you could maybe refinance into a new interest-only loan. Um, I really wonder who's going to do this deal for us, though, right? Like, who's going to make this refinance? Um, if the Dow had to take it over, you're not going to get a debt service coverage ratio loan for this amount, right? Because you're not covering your debt. even at here, you're not hitting your ratio, right? So that's what makes this really kind of scary for me. Let me start closing some tabs here. Okay, so we have the 5%. Yeah, this is just the insurance info. That's the loan info. Close that up. Just because my computer's been kind of weird, right? So this is the builder. This is their website. Yeah, I like to check them out because so really this situation, and this is what I wanted to talk about, is whatever yield you're getting, it's not coming from the property, right? Because when you have that debt, it has the lender has a lien on the property. It's a mortgage, and so all of that income is spoken for, right? Even though the co-owner is supposed to be paying that, at the end of the day, we don't have a mechanism for forcing them to pay it, and the lender can just foreclose on the home, and then so if the DAO itself can't afford to make the payments, we're at real risk there, right? Um, but so what if I wanted to invest in this because whatever they end up putting in here makes this yield look pretty attractive? For some reason, I want to invest in this market, right? Like, I mean, I want to know, okay, how likely is it that that co-owner is going to be able to continue making the payments, the $27,500 a month payment, um, when they're also paying us out, right? Because they've sold some equity. Uh, that's the real question, right? And so we got to dig into, well, who's the co-owner? Well, this is the building, or this is the builder, the company that they own, and I think they mentioned, yeah, this is the co-owner who they mentioned, but they had another name as well. And so I think it's just the initials for the two people. Well, no, because I don't know what the BH is, but the EZ is their initials. They're both Eric and Eton or Eton. I don't know how to say this name. Um, but so yeah, I don't know what the BH is, but anyway, just initials is where the EZ comes from. I think. Um, it looks like they really only have three homes on their website, right? Like, and this is one of them. This property that we're talking about is one of them. These are not like they just have our current listings. They have it listed as our projects. So it's not like this is a builder that's doing hundreds of deals and we're just buying into one. There is a little bit of discussion about them. Is it here? Where they had been in different businesses but they had grown up building with their dad, but they'd been in different businesses. I mean, you can read all of this. They did fix and flips for a while, and then have gotten into new construction. Um, but if this is, if I had seen 200 properties showing up on there, I'd have a different impression, right, than seeing three. So one, doesn't give me, especially when I know at least one of them hasn't sold yet, doesn't give me a ton of, it doesn't give me a great feeling about whether this is really built correctly for the market, right? Is this a product that the market wants? Well, it didn't sell at the price that they were looking for. So maybe the answer is no, right? Maybe they built a product that nobody actually wants there. It's not as if they've sold hundreds of properties and they really have that dialed in and know what the market wants, right? So that's one of the things that I worry about. But then the other thing is we don't get any financial information on them, right? They usually will give us a credit score. I don't see that yet. Maybe I missed it. But it might be because, again, this is a work in progress. Yeah, they don't have it yet. But, what would I actually want? What could they give me? Because this is a recurring theme on Lofty, right? Like it's a deal that makes no sense with the debt that's in place. And so what could they give me to make me feel good? It only works as long as that co-owner continues to pay the loan. Well, I want the full credit report, not just scores, right? I want to be able to look at all the debt, see all the types of missed payments if there were any. Really look at the full credit history because a lot of times the score, you can have a good score even though you've had all kinds of problems in the past. And so I actually would like to look at the credit report. I'd want full, personal financial statements and maybe financial statements for the company separately because although this is being offered by the individual. In this situation, we know, well, okay, that's the company. That's where they derive income from, right? And so I want to know about their income, their expenses, their assets, their liabilities, all of that. I mean, I want to be able to get a full understanding of like how likely is it that they're going to be able to pay me back. And then I don't know if it would be exactly a promissory note, but I'd want some sort of legal document that says if they don't pay the mortgage, that us as the DAO have some legal recourse, right? So what we're seeing in some instances is the co-owners just saying, no, I'm just not going to pay it. You just go ahead and take it over. Well, at the moment, we don't really have anything in writing that says that, well, we can enforce that, right? The bank can do it, but their main thing that they're going to do is to try to take back the property, right? That's typically lenders on real estate. Their first recourse is to take back the property, and then after that, in some states, and I don't even know the rules in Florida, they can go after a deficiency judgment in some states, right? We're saying, okay, we took this back, we sold it, we didn't get all the money that we needed, we have this deficiency, we can go and now attach other assets. Well, that's great that the lender can do that, but that doesn't help us at all, right? And so if we go and we pay back, we take over these payments, I would want, that makes the deal significantly worse for us, right? Because we go from having making money to being a money loser. Um, and so I'd want the ability that the DAO could actually enforce this somehow, that we can, go after that co-owner if it's a situation where they've just decided they're not going to pay it versus we think they really can't pay it, right? And like I said, I mean, we're seeing that now. Uh, and even if they're saying, well, I can't pay it, like in some instances, it might be like they're just, they have a large portfolio. They're deciding which properties they're going to try to save and which ones they're not. And so when they say they can't pay it, they really mean they can't pay all of it. But, maybe the one that the DAO owns is the easiest one for them to give up a payment on. So I'd really like to see some sort of, and I don't think, like one of the things um, that Lofty's response is, oh, well, the DAO can vote for anything, right? But no, we can't create a new responsibility on the co-owner with our vote, right? Like we need this to be a transaction that happens up front. That's a legal document where the co-owner is actually signing something promising, as a counterparty to the DAO, not just as a DAO member, like not as a vote, right? I mean, it's something that I'd want something in place where we can, have some enforcement mechanism other than just the lender going in and trying to enforce that loan. I'm sure there's, it's going to vary by state, but it's something that'd be very easy to write up. Um, it looks a lot like a promissory note, but it's not as if you're paying me. It's a promissory note where, you actually owe us the value of you not making those payments. So if you don't make the payments, we can make the payments, but then you still owe us. Basically, is what I'd like to see. And then I'd also like to see some enforcement where we have the ability to just instantly claw back your uh, tokens, the co-owners' tokens, if they don't make the payment, right? At any time, the DAO should be able to step up and make the payment for the co-owner and take that co-owner's tokens back, um, in payment for doing that, right? I think if we had both of those things in place, and we've seen this clawback mechanism written into the ones that look more like a loan. Um, and I've had a very similar video about those deals. But one of the things that have just become more and more evident is anytime that we have a co-owner that is committing to making a payment for the DAO, like, or for the, relative to the property, which is what this promissory note is, uh, I want to have the same sort of thing, right? I mean, like, because it is. I mean, you would think in any sort of normal world that yes, they have this responsibility to pay. The bank can go after them, but once they don't own the property anymore, right? Once they've sold 90% of their equity at the property, and some co-owners have sold more than that. Hopefully, that doesn't happen again in the future. Um, but once that's happened, the recourse for the lender is relatively low, right? I mean, they can just go after um, the property itself, right? And so, and then, like I said, I mean, maybe they can get a deficiency judgment depending on the state and whatnot. But so that'd be one of the things that I think that we can really bolster the protection and the enforcement of, okay, this is how this is what the co-owner has to do, and like this is our ability to actually collect from them. I don't like this solution, right? I would much rather the answer be you can't list a property on the platform that can't pay for itself, right? Like, I mean, that's what I've talked about over and over again. I think the right answer is it really just needs to pay for itself. If it can't, that's not a good investment property, right? Like, if I'm losing, if this property, without even digging, without even adding vacancy and collection and repairs and maintenance, if it's losing even with a four, well, even with a six percent mortgage, you're losing, and with the current mortgage you're losing $12,000 a month, almost $150,000 a year. And that doesn't even include, okay, plus on top of that we add, you know, well, I already talked. We add the lofty expense, which is 750 compared to that is absolutely nothing. But it is like you could buy a whole home here in Texas every single year for the amount that you're losing with this. Not a nice home. You get a new construction one or two bedroom in some parts of Texas, not even too far from me for that amount. It's just an insane amount of money to be committing to losing in a deal. And so I understand why they want to sell some equity in it, right? Because my worry is that equity is getting sold to pay interest payments, right? And over time, you're not in any better of a situation because you haven't paid down any mortgage, and we're not. It's not as if we're close either, right? Even if we get to a 6% mortgage, you're still losing almost $4,000 a month. And so, okay, let's say a year from now we can get a little bit higher rental rate. Like, okay, we get up to $1,000 more, and we get to refinance at 6%. Okay, well then we'd be losing almost $3,000 a month still, right? Like, I mean, we're just so far from making money, and I just can't imagine there's this huge rental pool at $22,000 or $23,000 a month either. I don't know that for sure. I didn't actually look into rental comps and whatnot. Obviously, if you wanted to buy into this, that's something to look at. But I mean, for me, just the gross numbers. And okay, so what happens? Well, let's say we just pay this whole property off, right? Like pay the whole note off. What if we own this free and clear? Well, let's look at this from like a 1% rule perspective, right? Like you've got 22,000 divided by, let's say we only do it at 4 million. We're being super generous because it looks like they're going to try to do more than that. Well, it's a 0.55%, right, rent to price ratio, which, I know you're not getting 1% most of the time, but like for brand new construction in my market, we can find zero point 0.8, 0.75, zero point 0.8, 0.85. Those exist like in a lot of our submarkets, not at this kind of price point, but I mean, so you can find a lot of deals that just make way more sense. And like I said, I mean, I just did this at 4 million, right? If this ends up coming out at at the higher, at 4.5, I mean, then you're even lower, right? Then you're not even, well, let's do it at 4.5, right? Let me just not do math in my head. So 22,000 divided by, yeah, I mean, then we're less than half of 1%, right? So this is a deal that like just doesn't make sense as a long-term rental. Does it make sense as a short-term rental? I mean, I don't know. It's something to look at, but my initial guess would be no, because I mean, are you going to really make more than 22,000 a month as a short-term rental? Maybe you could. I don't know. I mean, that's something that you could explore, but that's not what they're talking about here. They don't have any, there's no indication that they're even open to doing that. Um, so I find it really, it's a really tough deal for me to want to, like, really what you're doing is you're giving a loan to the co-owner, right? Like you're not, but it acts very much like that. Even though this isn't one of their deals that they've structured like a loan, but it's okay. We're giving them money. They're giving us a token, right? A piece of the property that uh, allegedly gives us some rights in the rent, but if they don't make that mortgage payment, and it has to be paid, well, we don't have a right in that rent, right? And so this deal, because of how bad the numbers are. I mean, it's not even close. It's like it is 100% dependent on them making that payment, right? And if they don't, uh, then it becomes a loss, right? And so, and we've already seen a number of times now, like if you bring a property to the platform and you have to sell it anytime soon, you're going to lose money just because of closing costs and everything. I mean, that's a fact of real estate in general, right? I mean, you buy real estate when you go to sell it because of the expenses. That's why people don't do 1 year holding periods unless they're doing a flip or something. People tend to buy for, hold for 5 years or more. Um, in order to overcome the expenses of a sale. But so it's not as if like you don't really have the protection where you could be like, oh well, it's a relatively safe. I could just turn around and sell it if that happens. It doesn't look like that's the case. It'll be really interesting to see what it actually appraises for. Especially if they end up trying to sell this out at anywhere over um, the where they had been asking, where they had it listed for sale. I mean, that'd be really crazy, right? But I don't know. One of the things I wanted to mention, I saw a lot of people in the Discord for this new channel already asking the right questions, talking about, I think that this is a problem now that more and more people have identified. What's going to be interesting to me is if our Discord group is, if it's really just like a little echo chamber of like, okay, now there's 10 people that really understand the problem, or if it's going to be like enough people that fully understand. Because one thing, I don't really have a good sense of like the ratio of lurkers to contributors in a lot of those Discord channels, right? And so it'll be really interesting to see. It seems like there's people being a lot more conservative with they're not just like, ooh, exciting, beautiful property, long-term rental, great yield. They're like, hey, how are we going to pay that mortgage? Like that question is coming up. What about the taxes? All these things. And I think this is how we need to just really hammer every single deal that's brought to the platform. And then hopefully, as a group, just not buy the ones that don't make financial sense, right? And I'm not telling you what to do on this one, right? Maybe they do something that makes you comfortable investing and just, counting on that co-owner making the payment. But it is definitely, it's that income is not coming from the property just based on the numbers that they provided us, right? So yeah, keep up the good work, everybody who is asking the right questions in there. But I'm so curious to see like, is there going to be an impact on how quickly these deals sell out? Are people going to be hurt for? Are there going to be more people that realize this is a problem because of the Yom properties that where the co-owners, the issues with the mortgage and the Thundersun Homes one, or is it going to be, um, like because there are thousands of investors on Lofty, and they're definitely not all active on Discord on a regular basis, and so are they going to see this new property and just be like, oh, pretty pictures, nice rental yield, let me buy that. I hope that's not what happens. Like I talked about the last couple of nights, I'd really like to just see Lofty stop listing stuff like this. But they're just trying to make money. So I think as long as people keep buying it, they're just going to keep doing it. I don't think it's good for their business in the long run. Obviously it's good for their short-term business, but in the long run, the more people just lose money on deals, it's I don't think it's going to lead to real growth. So I don't know. Hopefully they at some point get to a point where they are, their buy box isn't anything legal. Like I mean that's just, oh, I don't know. I keep just harping on that. I know, but it is like it. There's so much potential for this to be a platform where people actually make money. Not just people like you and me who are really digging into deals, but like where an average investor can go and buy into a property and pay a little bit of attention, but know that on average there's going to be good deals here. Like I said, I mean, for the people that are looking for that right now, I'm Mogul. I think is that's my spot for. I want to do a little due diligence up front. I know on average I'm going to be happy with their deals. I invest in about two out of every three that they put up there, and I honestly believe if I bought into every single one, I'd still do fine. But again, I mean, do your own due diligence on them just like you would any other platform. Um, but it's really like it's so hard to understand why we're still doing this, right? Why we're putting up properties like this where it is 100% dependent on does that co-owner continue to make that payment. And especially, I think one of the things that is even more problematic, yes, I think a lot of us investors now realize this is a problem, But I think now that co-owners sort of realize like, oh, having the debt gives me a lot more control over that property than I realized before, right? And this is something I talked about this with a couple people quite a while back. With when they were concerned about certain co-owner properties and wanting to take over some of the co-owner properties. I was like, I just would never touch them because being the one whose debt it is actually does give you more control and protection on that property than you would think. It is why there's a lot of rich people that always leave a mortgage on their property, uh, not because they don't have the money to pay it off, but because it actually gives them some additional protections and from creditors that are trying to attack that property, right? And so I don't know. I think that's probably too long of a topic to really get into, but it, it is leaving that debt, selling the equity in such a way that we're not counting on having to pay the debt and making, those economics where somebody else is paying it are just not it is just not fundamentally a real estate investment that you're making at that point. And that's it, right? And so hopefully, if anybody is interested in this property, I would push for some of those things. Say, hey, look, I would like you to do these things. If you want me to invest in this, I need to know about you as the co-owner. What's your ability to actually make these payments look like? Because $27,000 a month is a lot of money to pay monthly, especially if your business is you're a builder and your homes aren't selling, right? Like that's like, does this just depend on you selling out $27,000 a month in equity? And then if it does, okay, we don't have a lot of runway there before all that equity is gone. And then how do we keep making payments? And I think that we've saw that's sort of what we saw in Brownfield. And I mean, he's even said that like he was selling equity and putting it into that deal and into other deals that he was having problems with. Um, I guess one of the things that might make me feel a little better is, oh, we're going to take, once we get 200,000 out of this one, we're going to finish this other home that we already have, under contract to sell, and we just have to finish it, and then we're going to have a much better cash position, and we're planning on doing a buyback. I mean, I don't know. There's like a lot of answers to the questions that I think could make me feel more comfortable, but without having those, there's just no chance that I would invest. And really, without having some, like I said, some enforcement mechanism, some ability to collect, maybe even like liens on other properties or something, some other security that makes me really confident that yes, when push comes to shove, this co-owner is still going to want to make that mortgage payment. They're not just going to be like, I've only got 10% of the equity left in this. It's not very much money relative to something else. Let me just save my other properties and let this one go. I think that's really the risk, and I'm not saying I have no idea about this builder or this co-owner. Like it's not that I think something about this specific individual. It's just now I think that risk is more and more clear over time. And so it's that I don't know anything about that individual, and so I want to know that stuff if my entire investment is dependent on that, them handling that payment for us. All right, I think that is enough of that for today. Until next time, I'm going to keep complaining about the debt structure at Lofty so that you don't have to. But also, please complain about it too, because it is like until it's fixed, I really think it hides, it masks the way that those deals are. Right? Anyway, if you've been watching, my issue. So hopefully we can turn this around and get some deals on here that actually I'd be excited about buying. Hopefully some of those come up. All right, now until next time, the whole thing. Did you do the bell thing? Please do the bell thing. Oh, what did I do? I did something. I'm going to just close it now. Have a good night.